Micron has been one of the fastest growing stocks in the S&P 500. The stock is up over 300% in the past year. Then came the latest earnings. Revenue beat expectations, EPS beat expectations. Overall, very strong results. And yet, the stock dropped more than 30% at one point. This raises a key question. Is Micron still a buy, or has most of the upside already played out? To understand this move, we need to look at growth. Micron's growth has been strong but also highly volatile. The company goes through sharp upcycles, followed by equally sharp slowdowns. This time, growth was driven by a powerful combination. Demand for memory surged, especially from AI and data center markets. At the same time, supply remained constrained, which pushed memory prices significantly higher. A big part of this growth came from pricing, not just volume, and that led to a sharp increase in revenue and margins. But this is exactly where the risk comes in. Micron operates in a highly cyclical industry, and this kind of growth is not always sustainable. If demand normalizes or pricing weakens, growth can slow down very quickly. But expectations are extremely high. Forward revenue is expected to grow by around 87%. EPS is projected to grow over 400%. Long-term EPS growth is above 130%. Demand is very strong, especially from AI and data centers. Right now, demand is exceeding supply, and analysts are highly bullish, which means the bar is set very high. Now let's look at valuation. Over the past 5 years, Micron has traded at an average PE of around 11. Today, the stock is trading at about 16. That may seem higher, but for a company with this level of expected growth, it is still relatively low. In fact, over the past year, Micron traded at much higher levels, reaching PE ratios close to 40, which suggests that current levels could indicate potential undervaluation. And if we look at forward PE, it drops to just around 4. That is one of the lowest levels in recent years, and on the surface, extremely attractive. Now let's look at profitability. Margins across the board are expanding: gross, operating, net, and free cash flow. This is driven by strong demand and higher pricing. But this is exactly what we see at the top of the cycle. Micron is a cyclical business, and when margins peak, they usually don't stay there for long. The same story applies to ROIC. It is currently above 30%, which is a very strong level. But again, this likely reflects peak conditions in the cycle. Looking at share count, it has remained relatively stable over time. Dilution is low, around 0.5% annually, but the company is not actively reducing shares through buybacks. So shareholder returns are driven mainly by business performance, not capital return. Looking at the balance sheet, Micron currently has negative net debt, which is a positive sign. So overall, Micron is clearly a cyclical business. Growth, margins, and returns can change very quickly depending on the cycle. On the bullish side, generative AI and data-driven demand could support multi-year growth. But on the bearish side, the industry is highly cyclical, with sharp swings in profits and pricing, and that makes future performance less predictable. I ran a 10-year DCF using the Gordon growth method across 3 scenarios: base, bull, and bear. For assumptions, we're starting from $58 billion in trailing revenue, with year 1 growth at 85% across all scenarios, which is exactly what management guided and what analyst consensus confirms. From there, the scenarios diverge gradually, with the base decelerating slowly from 40% in year 2 down to 7% by year 10. EBIT margins start at 38%, and we're modeling them holding relatively firm given the structural shift toward high-margin HBM memory. CapEx stays heavy throughout at 30 to 34% of revenue. This is a fab business. That's just the reality, and that's actually the biggest drag on free cash flow in this model. The results? Bear case gives us $237, base case $391, bull case $849. Weighted by scenario probability, we land at a target price of $475. Micron is currently trading at $366, so the model suggests about 30% upside from here. What's notable is that even the bear case doesn't imply a crash from current levels, just 35% downside. Meanwhile, the bull case has you looking at more than double your money. The market is pricing Micron at 16 base PE right now, which is remarkably cheap for a company with 85% forward revenue growth. The skepticism is really one question: is HBM a permanent structural upgrade to Micron's earnings, or just another memory supercycle that eventually corrects? Our model bets on the former. And at $366, the risk-reward looks attractive. Now let's look at this from a different angle, a 5-year equity return model, which is simpler and more intuitive than a DCF. Instead of projecting free cash flows, we're asking one question: if EPS grows at a certain rate and the market assigns a certain multiple in year 5, what do we get? We're being deliberately conservative here. EPS growth of 35% base, 40% bull, 30% bear, well below the current analyst consensus of 130% long-term KGR. And exit PE multiples of 10, 12, and 8, remarkably cheap for any growing tech company, essentially pricing in that Micron gets re-rated as a mature cyclical at exit. Even with those conservative assumptions, the 5-year exit prices are $950 base, $1,367 bull, and $629 bear. That's a base case of nearly 3x your money in 5 years. The CAGR from today's price, 21% base, 30% bull, 11% bear. And the weighted entry price accounting for scenario probabilities comes out to $440. Micron is currently trading at $366, meaning you're already below that threshold today. So here's the bottom line across both models. The DCF gives us a weighted target of $475. The 5-year equity model implies a weighted entry price of $440. Both are above the current price of $366. Now, Micron is a cyclical business. That's not a secret. Memory markets have historically been brutal, with revenue swings of 30 to 50% in either direction. And we've acknowledged that throughout this analysis: conservative CapEx assumptions, conservative multiples, conservative long-term growth rates. But here's what's different this time. HBM memory for AI is not a commodity. It's a high-margin, supply-constrained product where Micron holds one of only 2 or 3 meaningful positions globally alongside SK Hynix. That structural shift is what makes this cycle genuinely different from 2019 or 2023. At 16 PE with 85% forward revenue growth, the market is still pricing Micron like it's about to fall off a cliff. Both models suggest that's too pessimistic. The stock looks undervalued. Not dramatically. This isn't a 5x no-brainer. But the risk-reward is clearly skewed to the upside, and at $366 the margin of safety is already built in even under conservative assumptions. If you found this analysis useful, a like goes a long way. It genuinely helps this channel reach more people who are interested in this kind of deep dive work. And if you want more stock analyses like this one, hit subscribe and turn on notifications so you don't miss the next one. I'll see you in the next video.